Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Man, I that intro went way faster than I thought it would. Well, we got I don't know. Market has been chilling out a ton, but we have a Senate Banking Finance Committee meeting where they are going to investigate what was going on with SEVB Bank, and the market is acting a little bit risk off in regards to this event. So this could be like the wait, that is not, hold on, this is wrong. No, I said 100 Thieves. Why am I the freaking music? There we go. Anyways, right now the market is kind of acting like it's over. I think that, again, my opinion is that what you're going to see is continued bouts. Like, it's going to seem like everything's fine, and then something else is going to pop up. It's going to seem like everything's fine, because as long as everything's fine, Federal Reserve keeps raising rates, and higher rates has been the real problem and culprit here, right? So could be difficult trading next year or two. Let's come over to the charts. So here you got the S&P, or sorry, you got the treasuries. So you can see that the volatility that we had since the 25 basis point hike is almost all out. We're a little bit shy. 114.16 would be kind of like the bottom of that. We haven't moved too far. I'm actually still like break even on this huge swing trade that I've been trying to work out. S&P 500 was really constrained yesterday. Like, just, it was a super slow day. It was super choppy. Oil taking a little bit of a jump there though, and natural gas continuing to fall. Let's see, $2 soon maybe. Gold and silver, well, they took a little bit of a dive yesterday, but I mean, that still looks good, especially silver. That chart in silver looks really good. And the copper also recovering a little bit. So we are getting signs of like risk on global growth kinds of movements. And then we got Bitcoin. Bitcoin, we found out, was taking a dive because the CFTC is going after Binance. And I'm like, yay. Seems like so far Binance has been able to stem the tide. They're kind of like, well, we're not manipulating the markets. But then I'm like, well, I mean, it sure looks like you are manipulating the markets, because you're like 90% of the market and they only dropped $1,000 off of that. Yeah, I don't believe you, Binance. I don't believe you one bit. And the dollar back below 102, which is a little curious. I mean, well, the risk off movement is leading to sell-offs in the dollar. So that's where we're at. So as for us, let's double check. Good morning, Octavius. We did just have US retail inventories and advanced goods. Didn't really see any significant movement off of that. Wholesale inventories was spot 2 versus an expected negative spot 1. ECB's Lagarde, Nigel, and Villeroy speak at the top of the hour, and we're also going to get the Case-Shiller and the house price index. And then at 8 o'clock, we get consumer confidence, and Fed's Bar will be speaking I don't have on here the congressional testimony, but that happens today as well. I assume that that would be later in the day, though. So we might be able to pull a trade out of this before any of that kind of gets started. Will we get all the way back up to 03.5? I mean, I'm seeing a little bit of bullish action here on the start. It's really tepid, but I think that we could see some upside. So why would I think? Well, I think that people are hedging ahead of that Senate Finance meeting. It's kind of the thing. So I guess maybe I could say that we are going to see some upside, but I don't like this trade so much just because I don't think that much volume is going to come from it. I don't know. You know, I just really hate some of these live events where, like, the press conferences, right? I just hate the live press conferences. So what I think it really comes down to, especially the ones with the politicians, because the politicians are just so... Ugh. I hate it. I just hate it. Wow, 39 dead after fire rips through Mexican migrant center? That is insane. I don't think that you're going to hear too much about that one on the news. I tell you what, I am more and more frustrated by the whole news situation, like what gets reported on and what's not. It's never been balanced, but yeah, it feels to me like it's just getting worse and worse. And there was the whole shooting yesterday. I don't really want to go into it beyond this, but it's just like, yeah, if you can't make Republicans look bad, then everybody shuts up about it. I think that's what you're gonna see today. If I'm a gambling man, I think we are. We need to go long here. Oh, I think I missed my spot. Who wants to just keep going, maybe? Nah, it's probably gonna... Let's see. I just blew my nose, and that was one of the most satisfying nose blowings of my life. Like, the nose is clear, but there was something deep down in there, and it all came out. Felt good. Man, I missed a really good... I was like, I'm gonna, as she goes right there, and I barely missed it. I know, it's coming back, so maybe it wasn't quite as good of a position as it appeared, but... I don't have to be too panicked about missing it because I do have a position on anyways. Well, let's look around the internet. See if we got anything. Oh yes, I do have something interesting they have to do. I don't know. The overnight talk is pretty meh. Oh, wait, did I get filled? Oh, I did get filled. Yay! Well, I'm liking this so far, and there is definitely some volume coming in here. And it's very much across the board. Oh, by the way, we need to turn on our strategy, huh? Yeah. Oh, wait, the strategy isn't gone. Why is that? I don't know. This is a little bit too easy of a call. Well, there's this little area above us that I am concerned about. In fact, yeah, and I'm already okay. Well, so I'll take one contract off there. That gives me a good break-even point. So what I am seeing, is below 4% again. Well, twos have been below 4% for a while, though. They're awfully close to 4, though. Oh, I guess maybe they were above 4% overnight, perhaps. I don't know. I don't know if that's really an area that the market is too concerned about or not. Anyways, what I'm noticing is that when I look at my cost basis indicator, it looks like there was quite a bit of positioning picked up overnight around the 115 area. Of course, it's shifting because there are new people coming in and all that. But that's why I'm looking here at this spot thinking, oh, okay, you could see some position adjustment here. And then when I look at the DOM, I can kind of see that low resting liquidity in the middle, a little bit of heavy volume having traded in that area and so forth. So some very early signs of a node. And so that's why I took one contract off. I'm thinking about, is it actually hot in here? But I'm not too sure. I don't know, guys. I don't feel like I have a whole lot to say today. I made this post on Reddit. I know what we can talk about. I made this post on Reddit basically saying gurus will always disappoint you because, you know, you're focused on the person rather than the knowledge or abilities, and you're not asking if there's actual empirical proof behind the knowledge that they supposedly have. And just as usual, it's just a total disaster. Zero upvote. It's zero. The upvote rate is 39% though, which means that like a lot of people did upvote it, and it got a lot of views. But the comments in it were just like, okay, you people clearly just want to be abused, so right, because the top person in here is like, well, you just need to have hours of looking at price action. No proof that price action works, folks. And when I questioned him on it, his response was basically like, well, I know that I can't prove it, but I still believe in it. Okay. We really can't complain. We make our own decisions, and it seems to me that you always got people sitting there trying to tell you what's going on, and we just ignore it. Everybody does it. I don't believe you. So again, if it works, it should be able to be proven empirically. It's more likely that you're making money from taking on the risk, or unconsciously, right? It's like it just pisses me off to no end that people that have been here on the stream for years, frankly, will say shit like that. Like, are you just egging me on, TLA Trade? You know what I'm going to say, right? You know what I'm going to say, right? There could be, he could have, well, supposedly it's worked for 10. I don't believe you, frankly. But there's plenty of reasons why that might not work for somebody else. Maybe he was lucky. Maybe it doesn't work anymore. Maybe he doesn't actually understand why he's having success. Maybe this success isn't coming from what he thinks it is, right? Maybe it's just that he's taking on excessive risk. That's why you have to prove these things empirically. If it works, where's the proof? Think about it. The whole point of these price action strategies is to create something that is less discretionary, to be able to say, here is a pattern or a thing that you can go in and you can, it should be easily back tested. It should be so easy to get empirical evidence. Where is it? I don't understand why you want to use so much energy. Because it pisses me off, TLA. It honestly, to God, pisses me off to see so many people, to see thousands of people just ripped off every day by complete bullshit. That's why. It pisses me off. And then you have like real market information out there, real things that you can prove at least. Nobody cares. I'd rather believe in price action. And I just can't, you people, it makes my brain hurt trying to think about how you could be like, oh, this is like such a, you know, here's this exact pattern that I'm supposed to do. And you don't ever sit back and say, oh, like, what are the stats on that? Like, how has that actually performed over the last 10 years? Like, did you have proof about that pattern's actually a thing, or why that pattern actually works? Like, there should be studies about this. Like, if it's that, like, seriously, this is straight up the most popular retail trading strategy. And you're telling me that nobody in the past 20 years that this kind of idea has been around has been able to produce empirical evidence that it works? There's not a single scholarly study on it. And yet you guys all still believe it. Explain that. How can that be? These methods have been around literally for decades now. Nobody's ever done an empirical study about it. Nobody's ever produced real stats. I say, where's empirical evidence? Nobody can show it to me. Right? Past performance isn't indicative of future results. Well, do you have past performance to prove it works? Well, no. That's not exactly it, right? You don't want to look at the past performance of an individual person. You need to look at the past performance of the actual strategy, right? But this is just the thing is, okay, past performance is not indicative of future results, but that doesn't mean that all past performance is no longer going to hold, right? Like Ken Griffin has made money in the past at Citadel, and I'm pretty confident that he's going to make money next year too, right? But that's not because he made money last year and how much money it was. It's because the edge that he's trading off of is well defined, and we can quite clearly explain why it works and how they're able to develop their edge and so forth, right? Or how they're able to produce that edge. So I'm no, I wouldn't say the past performance of the edge is always indicative of the future results, but it's a pretty solid start. I guess the point is, part of the thing that I've been trying to say is that if you actually look at empirical data over the course of 5 years, that eliminates 95% of the supposed edges out there that people claim, right? It's just a really strong filter. But if we have the actual strategy, okay, not one person trading the strategy, but if we have a way to actually duplicate the strategy, like algorithmically, so that we can run it against any data set that we want, then we can, then you know, like, what the actual performance is, right? And then you can say, yeah, there's going to be failures here and there, but we will be able to actually see what the performance actually is, right? Wow, this thing looks like it's coming all the way back. Given as much, then what keeps the edge from blowing up the strategy? And I guess the other issue is that if I'm able to look at the actual statistics of the strategy, I can determine if, you know, there's a lot more nuance about performance, right? So then, because I come and I look at the performance and then I see, oh, okay, except for that your average loser is like 4 times what your average winner is, right? Then I know exactly what you're doing right there. Sure, but wouldn't you rather your trading be based on something that's real rather than some voodoo magic that somebody on the internet just kind of told you that it was working? I mean, that is kind of the point, right? Is that you could trade for years and have success with it, and then all of a sudden find out that it was all pure luck, or that it was all just having to do something to do with the amount of risk that you're taking on, and you just somehow had always gotten away with it, right? And what happened? You just lost 3 years of your life on something that meant nothing. And you built all of this stuff and you built all your personality around the success and, oh, yep, you're telling everybody. And then later you find out it was bullshit. Wouldn't you rather avoid that? And just start out with something that you know is real? Start with from a premise that you know is real at the very least. I know a lifetime of trading seems like a long time, but it's actually not that long. If you every time that you're testing a new strategy, it takes you years to figure out if it works or not, right? You'd rather have the pure luck. Well, I guess the issue with that is that I'm saying that if you have the pure luck, that it'll eventually take it away from you, right? So I don't think that I want the pure luck, because if it's pure luck, then that says that you lose it all. And I think that I would rather have just never had the money to begin with, rather than had the money and then lost it from my own stupidity, right? I would all that guarantee that an experienced price action trader could outperform you by an order of magnitude, assuming you were using this no stop loss approach. I think that if I was using the same kind of risk management strategies that they are, that I could outperform them. I say that because I come in here and do degenerate things with the sim accounts, and I just blows the water out of some of the things that I've seen other people do. The risk management strategy is to well, okay, so risk management is kind of an amorphous term, right? But essentially, I have like a maximum loss that I set when I get into the trade, depending on both the situation and the type of trade that it is, and so forth. You need to score 66%. That would so getting 66% and 1.5. Your winners are 1.5 times your losers. I don't think I've ever seen somebody show me stats over more than 3 months that were that good. Okay, Trading Bunny's asking real questions. Is it the primary job of Quantset Institution is to take the info from the microstructure research and implement usable strategies? So there are a lot of different types of quants, but a lot of quant research is exactly that. Yes, is they are using what they know about the market microstructure to do more optimal execution. Because a lot of what kind of ends up being important to those kinds of strategies. So for instance, you have this big portfolio allocation strategy, and it's going to say you need to buy this thing and sell this thing, but then another part of that same strategy will say you need to buy this thing and sell this thing. And so if you like sold something earlier in the day and then buy it right back, that's kind of dumb, right? So they go in and they figure out, you know, what you're doing, how likely you are to do something with it later in the day, and all sorts of crazy stuff that I really don't understand, to reduce the amount of churn in the portfolio, for instance, and then different ways of executing it to have the minimal impact on the market. But the things that we know about market microstructure come primarily from the field of optimal execution, or rather they're considered to be useful for optimal execution. A lot of quant research is not regarding alpha per se, it's about reducing cost on beta, which translates to alpha. How much do you make per trade and max drawdown on that? Adjust for the leverage? Well, on these trades, it's been like, I think the thing that's crazy about this is that I think that overall I make 50-50. I don't know, let's go look. Okay, so first of all, let's make sure we understand what beta is, right? So beta is a marker of how much an instrument moves relative to the S&P 500, right? So if a asset has a beta of 1, then that means that if the S&P 500 moves up 1%, that stock also moves up 1%. Okay. So he's saying, you want to get a certain beta. How do I get that beta in the most efficient way possible? And that ends up giving you alpha, is I think what he said. And what the methods are that they use to do that, I don't know. Oh, I think I did take a little bit larger of a loss here than I would have liked the past week on the sim account. Dun, 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 dun. Okay, so it's been a little bit iffy lately. Oops, this way. So I've had a good run, had a couple of big losses in the recent past, but it's still up 15,000. And there's probably one situation where I had a let's see here, can it tell me where I sized them, like number of contracts per trade or something? So it should be max 5, but okay. So I win 62% of the time. My average MAE is 6 and my average MFE is 11. So I'm getting, when I go in and I start doing my kind of excessive risk nonsense, I'm getting a really high win rate. And my winners are larger than my losers. Actually, so my average winning trade is not... Okay, so that's not 100% true. So it looks like that from my average MAE and MFE, that there is some real edge, which is to say that the ones that go are going further than the ones that go against me. But because of the way that I'm managing the risk and so forth, my losers are a little bit bigger, about 1.5 times my winners, which is not good. But I have some winners that are really, really good. So it all kind of comes out positive in that respect. So that's how I'm doing it, right? So this is kind of where we're going back about performance, right? So when you actually look at this, when you can actually look at the stats, we learn some things about the way that trade is actually working, right? People just come in and say the only thing that matters is the amount of money that you made at the end, right? Well, if it was just about the amount of money that you made at the end, I think that when you do that, it does pretty damn good. What matters is the amount of money that you lose. Well, okay, but I made more than I lost. Is a pretty bad drawdown. So it went as much as 50%. So the Sharpe ratio is probably like 0.3 or something, right? Or another way we could say it is that the most important statistic is what your risk-adjusted returns are, and the risk-adjusted returns of these kinds of strategies aren't very good. Take your stats and do a Monte Carlo simulation. I tell you what, I've had a lot of people that have been like, oh yeah, I did a Monte Carlo simulation though, and it worked really super great. And I'm like, I don't really think that those give you very accurate numbers. Okay, so if we say that the portfolio is 100,000, just for the sake of argument, and I'm risking max 1% per trade, generally speaking, and the winning trades are 67%, 62, 63, we'll say, we'll round it up, 63%. And I don't think that there's doesn't tell you like break-even trades or anything, does it? No. So we're just gonna say 0 break-even trades. This was over a 15-month period. 15 months, we took how many trades? 200. 210 divided by 15 equals 14. 14 trades. And then we want like 60 months. And I'm gonna say the take profit stop loss ratio is 0.5, even though that's not quite accurate to what it is. Okay, so I think we need to do that a little bit better. What actually is it? $664 divided by 461 equals no. 461 divided by 664 equals 0.69. Okay. Well, okay, there you go. Seems difficult to calculate a win rate percentage if you have to constantly adjust the risk because you're right about strategies working more if more risk is assumed. Yeah. I read a study that said that if the current SPX return, given its standard deviation and CAGR, I forget what that stands for. There's lots of, okay, the compound annual growth rate. There's been a lot of, I can't remember the discussion, but I remember seeing a bunch of people on LinkedIn arguing about this. Some people were saying that the CGAR was all that mattered and that they were all disputing that and stuff. That's why I keep on asking him to adjust for leverage. Well, so the whole thing is that like the amount that you're actually getting in a year is, so like if you make 10% in a year, then the amount that you start taking on extra from extra contracts is not really very significant at the levels that we're talking about, right? But I digress. I haven't this is like without sizing up, or well, I mean this I would assume is sizing up, but like what I do is basically not sizing up. I just maximum 5 contracts. And I don't think that I would be going up to more than that unless I made like 50% or something like that. Just because, like, why introduce another factor into it all? Okay, but with those stats, one of them, it says that you make 2.65%, and in one of them, it looks like you lose 20%. That sounds about right. So, like, the reason why I have issues with, like, these kinds of Monte Carlo simulations is, like, they say that given those parameters, the max consecutive losses you should get is 6 in that situation, and it's almost always more. Like when I actually go and do a back test, so let's go back and look at some of these back tests that we were looking at the other day to give you an example. Okay, so we were doing this low R2 one. Was the one that well, the Sharpe ratio wasn't very good on it, but what was the max consecutive losers that we had? In total, 8. But in long trades only, there was 14 consecutive losers at one point. Okay. This one, it's saying max consecutive losses 6. Now, most of these you come in and you're gonna look. So let's look at some other ones. This volume weighted moving average breakout, for instance, which is one of the best performing. Okay. Max consecutive losers 9. 9 is a lot. For 2-to-1 risk reward, that's and 41% win rate. That's actually really good. It probably should be more like 13. Or what if we go to one that has a really high win rate? Okay, range deviation. Five. That's not an actual simulation to do it with your own balance and see where it drops below. Well, I'm not sure I understand what you mean. Oh yeah, if we were to do it with my live account, if we were to come in and say, I only put 1,500 in there at a time, right? So if you simulate the returns on that, Well, actually, that one was not so bad. It's saying that I could 5x my returns. But the one that it's saying is the lowest is only losing 1,300. No. Okay, Anastefa, I didn't even look at your pictures. Let's go look at your pictures real quick. Oh, you have some back tests. Okay. So it was only about 60 trades, so it's not very much. This is what we really want to see. No, it's totally relevant to what we're talking about. Well, that's pretty good. You're getting 67%, and you're getting your winner is larger than your loser, and you're getting so the stat, like the numbers alone are phenomenal, but it's only a week of trading. Yeah. So you need to run that over, you know, if you can. And I'm assuming, well, so how many are you taking a day? 11? I would not say so. So if it's a Gaussian distribution, then 50 is usually, then 50 trades is enough to have a statistically significant result. Yeah, but what we do in the market is always fat-tailed, almost always fat-tailed. So I think that you should assume, like, at the very least you want 1,000, right? But like the bigger issue in this one is that it's only from the 16th of March to the 23rd of March, right? It's only like one market period, right? Like it's a period in which we know that the market has been a certain way, and it's been unusual kind of way as well. Yeah, maybe. But then it would be like this. Okay, if there's only a certain kind of environment that I want, that I know that this is profitable, then I would want to build that into my back test and still get as much trading over, you know. So if I can go back 10 years, like this is the thing, man, is like, if you're only taking, if this is only using intraday data, if this is just using prices, right, you're not incorporating order flow into it, then it's not hard for you to go back and back test 10 years, right? Like you should just go and do as big of a data set as your data provider will give you. Why wouldn't you? Right? But then, yeah, if you can model that environment and only have it trade during that environment, and then you could see how it performs. But I'm still going to say that because of the fat-tailed nature of markets, that 56 is probably not enough, right? And you're not going to see that fat tail until you get a lot more data. That's why you really want to shoot for, like, you know, number of trades in the thousands. That's why I have a couple of these over here when you look at them where the total number of trades is low, and I always kind of ignore them because, like, oh yeah, they look like good numbers, but I know that once you start to get to like thousands of trades, that the Sharpe ratios decline pretty quick, right? But then you could almost all blowups happen due to that. I'm not convinced. So the first thing is that most of these gurus and stuff don't say something like that. They don't say, this only works in this environment, this only works in this environment, right? Number two is that you can still backtest it, right? You can limit the trading to a specific environment, right? So yeah, it should work in every environment. That's what they tell you, but it's nonsense, right? Your strategy absolutely has to, because that was the whole start of the conversation, Akshay. Oh man. What exactly? I don't understand what the point you think you're trying to make is. Let's go back here. What exactly is your thesis? So my thesis as to Stefa's results is he needs more samples. He needs more samples. So if I don't know, he thinks that it should work in every environment, right? So then make the backtest be the last 5 years. It'll take longer for you to download the data than it will be to run it, probably. It'll only be like a 5-minute thing. Why wouldn't you? Right? But the whole thing is how do you know if the stats that you're seeing are just because it's not a lot of samples? Nah, I don't think they are. Sorry, these aren't his. These are mine. Here's his. Okay. You can't. Okay, so these are your traits. Well, then it's kind of there's kind of no point to it, right? So maybe I should hit on this point a little bit more. Okay, I have found so often that profitable traders don't even understand why they're profitable, right? Like they're picking up on a certain thing that's like a pretty significant part of their edge. And that's not the thing that they're focused on. That's not the thing that they're thinking about when they're taking the trade. And they literally don't even understand where their edge is coming from, if they actually had an edge, right? It's so very, very often. So I can't look at one person's results and say that those results are indicative of anything to do with the strategy, right? Because I can't prove that they're actually trading the strategy in the first place, right? If I define it algorithmically, now I can say this is the strategy. This is how the strategy performs, and you can be very specific about it, right? Okay. So let's just say that this was a back test. Okay, if this was a back test, then you would want to have more than 56 samples. Because the market is fat-tailed. 50 is only good enough if it's Gaussian, right? It's almost never Gaussian in markets. Almost never. You need more than 50, man. 100% you need more than 50. And especially with stats that good, yeah, you need more than 50. Because they're suspicious. They suggest a fat tail. They suggest that at some point you run into something that's really nasty, right? And then you're like, well, okay, that just means that it only works in certain environments. Okay, but can you actually successfully define an environment in where that works in and a filter where that works? Because that's a lot harder than you might think. I've found that that's a lot harder than you think. So I've had plenty of strategies where they come in and I look at the results and I was like, okay, it does really good in this market and it does really terrible in this market. So when do we actually trade it? And the only one of those filters on, like, I would call it a higher time frame filter. The only one that I've ever found that is really significant is the daily ATR or just volatility in general. Like when the market gets too volatile, you just don't trade. You're about to reach 10,000. Thank you very much. I don't know what if there's anything for me to do about it or what. Well, it looks like you can pass it, right? Or did you pass it? You did pass, or I'm assuming that you were trading that live or not live, but you know, on the account, and you passed. But the reason I'm bringing the gurus into it is because the way that this whole conversation started was me complaining about price action again and saying, how is it that this has been around for 10, 20 years and nobody's ever produced a piece of empirical evidence showing the performance of it? I was just on Sim to look if I could pass it. Unfortunately, I have very little time due to my studies. Well, okay, so my question would be, why not just trade your own account? No money? How much money do you think you need? Well, what was the max drawdown? 875. Save for 2 months for a year and get 2,000 and trade it live. I guess if you can afford 150 now and you could trade it, but then what you would want to do is once you've pulled out about $2,000, you would want to stop and go and trade your own account, right? Yeah, you can have 20 accounts with funding firms, but so what is our takeaway from that? That the advantage of funding firms is to do degenerate things, right? To spin the wheel on risky strategies that we don't really want to risk our own money on, right? Like what I do here on Sim, yeah, I would totally go and do that on a funded account. So spread the risk. Why? Do it on a funded account? I don't really see the point. To me, live stream. It sounds to me like what you're trying to say, Akshay, is just do the thing that will do the best for the stream, and you know, if you get some crazy profits and you do some crazy things along the way and everything, that's super cool, and that would be worthwhile, right? And you have 100+ viewers. I don't want 100+ viewers if that's why I have 100+ viewers. See, here's the thing. Okay, I'm not making thousands of dollars doing this, okay? But if I was to come in and I was saying, okay, I'm making tens of thousands of dollars doing this, and you all can duplicate it, and then you all become super interested because of my past success, and you all start trying to trade the way that I do or following my trades, right? I would have done no good. There would be no point to it. Why is that? The point here is you need to be process driven, not result driven, right? You need to say, here's the process that's most likely to lead me to success, and I know that there's a large degree of randomness to it, so I just got to focus on doing my process correctly and hoping that the results follow from it, right? that's going to be a tough road along the way, right? You're going to try it and you're going to fail. It's the way that I trade. It requires like maximum experience, essentially, because you need to understand like the actual market. You need to understand what's going on, and you know, understand based on the news and so forth, the decisions that people are going to make. Forgot to turn on the fan for my camera. In that world, how are you going to keep going? You have those problems and you say, I screwed up. Does that mean that thing doesn't work? Or do I just suck at it? What's the problem? Right? What keeps you going? The only way that you're going to stay going is if you just love the market. Right? So see, if I come in and build the stream off of the idea, you know, off of clickbaiting everybody into trying to trade the way that I do in the hopes of gaining excessive profits, then I haven't actually helped anybody, because I'm just pulling in a bunch of trash, essentially, right? And what do we actually need? We need people that are just genuinely interested in the markets. And I want people that would do this even if there was no way for them to make money from it. Even if they knew that they would never make money from it, that they would still want to do it. That's the people that I want. It's a filter, right? I'm filtering for the people that are actually going to pursue this correctly, that are going to do it because they love the market, and they're going to try and take an empirical approach, and they're going to take in all of the information that we know and to trade all of these different things, and they're going to ignore things that we can't prove and that are told to them by gurus and other people on the internet, because they know that they know what the statistics are, and they don't want to waste time on methods that aren't proven, right? So if I had 100+ viewers every stream, I don't feel like it would really be helping my purpose in life. I would like to have 100+ viewers on my stream, but I want it to be done in a way that it's still helping you guys, right? Because I could go and do what Matt and all of these other guys do, and it would be successful, but I don't think that it would actually be helping you guys, you know? I want the YouTube channel to be successful, but not at the cost of the benefit that this channel provides to the community, right? And that's why you're never going to see me use, you know, these clickbaity headlines about trying to give people false sense of how much profits they're going to make from a certain strategy and all this sort of stuff, right? I know at least 10 people who love the markets, and they spend the whole day looking at financial news and track stock prices, and yet they don't have any investments in financial assets. So what's the use or benefit of them being interested in it? Well, they're just kids. Are they like in their 20s? Because if they're like over 25 and they don't have any financial assets, that's pretty disturbing to me. That's pretty disturbing to me. Oh my gosh. Ugh, that's awful. What the hell is wrong with them? What are they doing with their lives? How can you be that old and you don't even have a 401k? Like what? Freaking, man. That makes my head hurt. Because they clearly didn't learn anything from it, did they? I mean, if you're really listening to what I'm saying, you're probably going to, at the very least, fund your 401k with your employee match before you start doing your degenerate gambling over here, right? Oh, you're not in the USA, so you don't get 401ks. No. Markets are rigged. Yeah, lots of people. I mean, that's kind of funny though, because they're kind of rigged in favor of the people that hold the longest, right? See, I continually feel frustrated as a content creator because I don't feel like that. I've made the content that's like the education, and we can sit here and stream. I mean, I haven't been trading this last little bit. I tried taking a shot in this crisis, and it was a pretty bad failure. I avoided the rest of it. I don't know. I'm not quite sure. I don't see what's on the horizon that we start taking trades off of. It's kind of like, what am I even doing now? And it does make me want to be like, okay, let's just do all the degenerate stuff and get as many viewers as possible. But then I also think, you know what? Even if I was doing all of that stuff, I don't think that people would watch. So I think the things holding the viewership back on the stream are bigger than that. I think a lot of it is that YouTube just really doesn't send people to it, right? It's probably the place where you're gonna get like the viewership is like having a really big Discord and stuff like that. And the conclusion that I'm making, what it seems to me is that we will never get that because of what we're teaching. We'll never get that because of what we're teaching. That in order to get that kind of viewership, I would have to become a price action guru. Whoa, what's going on? Wow, U.S. accuses Bankman-Fried in the new bribery conspiracy charge of directing the transfer of at least 40 million of cryptocurrency to benefit Chinese government officials. Wow. Is Bitcoin reacting to that at all? They're still kind of on their side. But man, the S&P 500 just all of a sudden sold really hard there. Well, I'm going to keep my risk low for the moment. I'm not quite seeing the same kind of like bullish movement that we were earlier. Yeah. Anyways, you can start trading mini NQ and teaching your methods and teachings. Well, I don't know if what we know about markets is that useful over on the equity indexes, to be honest with you. Because I've never been able to work something out over there that was better than for more than a month. I kind of feel like that if I was really going to have a strong edge over in the equities, that it would have to be based on something a little bit more than that, like, you know, some sort of arbitrage sort of setup. You know, like when the futures get so far away from the actual index, and then I try taking a trade or something like that. So your methods aren't really about the markets as a whole, but a specific subsection of the market. No, it's not that. It's the equity index itself, right? It's something that I would say is pretty indicative of the markets as a whole, but not indexes. And more so, I would say the reason why it's not even that those properties don't apply to indexes so much as it is that the noise in the indexes is just so high that, right? That in order to do what we're talking about in the indexes, you'd have to take really, really wide you'd basically be swing trading, right? Wouldn't be scalping anymore, at least. Or it wouldn't be day trading anymore, let's say. That could be good, right? Speculative trading thrives on noise? Could be. I mean, I think the issue that I had was I was having some success with these sorts of things in the S&P 500, but it was like the amount of risk that I had to put on in order to do those kinds of trades. It was just too much. Like the market always, when the S&P 500 gets crazy, it's way too much, right? The treasuries get crazy and it's like, oh, okay, I could lose $50 in a day. But when the S&P 500 gets crazy, even on these micro futures, it's like they'll just blow your account. They'll just wipe your account, right? Is it traditional market making that suffers in the noise? You get a lot of toxic order flow your way. I think that's true. Yeah. I mean, I think that the market makers, their market makers over in the SPOOs are incorporating other stuff and that it's okay. But yeah, there's just a lot of noise over there, man. It's a lot of noise. Like I really think that most of the people that are making money over in the SPOOs, that it's just noise. I think you need a lot of samples to really prove that you actually have something over there. But anyways, I was about to go a step further, and I was going to say, you know, if I came in here and I traded the NQ and I was telling people to trade price action, I still don't think that the stream would go to like 100 viewers. I think that there's just, I'm not sure if Seth has what it takes to make a stream successful using that. Someday we might get lucky and the algorithm will send stuff our way and the stream does become good, but it's going to have to be Seth being Seth. And if that never happens, I'm perfectly fine with that. I don't care about that. And so the whole point of that was to say, this is why what I'm focused on is doing what I think is going to be most useful for you guys in the community. And I don't think that the most useful thing would be larger community. Yeah, that's part. There's congressional testimony coming up later today, but those usually don't start until like 10 o'clock Eastern time. So I'm now this headline about Sam Bankman-Fried being charged with paying a bribe to the Chinese government is like all over the place. I have not seen cryptocurrencies like move off of it, but I actually think that this could be a significant headline. So I don't think that you would want to trade these kinds of headlines in the cryptocurrencies because as far as I can tell, that market is just manipulated, right? But I think that this could be very damaging for Bitcoin. Because Binance is the largest exchange. Right? So I was just thinking, you know, so if I'm gonna do, what are the things that like I can do that are most beneficial to you guys and help the stream out? It's not going to be, oh, here's price action. You can make so much money from it. Yeah, blah blah blah. Nah, I don't give a shit. It's gonna be more general things. It's gonna be like, here's some, you know, cool hardware that is useful to you. These sorts of things. The things that have made our channel successful in the past, right? Talk about the computer hardware, you talk about the back testing, you talk about the research, You know, if there are services and so forth, we review the services. We review the different trading platforms, so you know what's going on with them. Right. That's where my focus should be. And my focus here on the stream should be on helping the new people that are in here and getting good trades, and not on being the most entertaining or attracting the most viewers. That's what I think. That may seem a little boring, and it does kind of seem boring to me. I get tired of it sometimes. Analyzing the news, yeah, totally. But I don't know. That's just me seeking novelty in my life. That's not me not understanding purpose or feeling lost in purpose. No, I think that I have my purpose very well set. In fact, I think that my issue is that I've had my purpose so well set, and I've been so successful at it that, you know, I'm constantly seeking more. Speculators, Seth, should only speculate and not speak things. I'm a little so what do you guys think about this rise that we had this morning? So when we started out, it definitely felt like there was a real order flow coming through, and I thought, well, because there's congressional testimony today, people might be hedging against that. So that's what I traded based off of. It worked really, really well. That move has mostly come out, and now we've been chopping down here for about 40 minutes. So it's back into a really quiet, choppy market again. Yeah. I'm having a hard time here, like, accepting that volatility is just like completely coming out of the market. I feel like that there's no way we could be done. You know, after all of the craziness that we've saw, how could they be done? Yeah, consumer confidence is probably gonna move us, huh? In fact, I should prepare myself to take a trade if we need to. So last reading was 102.9. Current reading is 101. I don't know how they do that poll, how much of this latest banking crisis would affect consumer confidence. I would think that it's probably be weaker than it may be underperform. Might be less than 100. Yeah. I don't know. It's over the past week. I just haven't been as chatty. Sorry. I don't know what's with me. So you know what I did yesterday was I was messing around with ChatGPT and everything, like trying to figure out to make a persona and everything. It seems to me like the technology is there, but like the specific application is not. And so like ChatGPT does not remember what you tell it past one session. So we'd have to run our own model. We'd have to run our own model that remembers everything and uses reinforcement learning over the things that we want it to. It's a lot of work. In order to do this thing, we really need the processing power. So that was a little disappointing. Well, seems like the treasuries are starting to push pretty aggressively to the downside here ahead of the consumer confidence number. Will be soon, but paid? Yeah, that could be. There could be, if I pay $20 a month to get my robot its own permanent memory. It seems to me that like what I want to do is something that you could probably get a big corporation to fund, right? It's to say, okay, we're going to trade with, we're going to create a streaming, or not a streaming, you could do both. You do one or other or both at the same time, but one would be a streaming assistant and one would be a trading assistant. And, you know, do the reinforcement learning with the trading assistant. And that would be something that you could then turn around and sell to the big banks and stuff, right? But I'm gonna have to bootstrap it. I think we can do it. But it's gonna take some time, right? It's gonna take some time to do. Plenty of iceberg activity at the open on ESF, says Bookmap. There was like a really strong down move and they kind of were able to absorb it. We've had a net 5K orders buy in the equities. Do you know of a company called Toluna? No, I do not. Great way to answer surveys. Sounds like a waste of my time. I love what you do. How do I interpret other flow and take the trade? Well, so the key insight that I want to give you on that note is that you really want to predict what the order flow is going to do. You want to have a scenario in your head where, because of this thing, this piece of news, or this particular thing that this strategy has to do rebalancing or whatever the deal is, that we're going to see buying today, right? And then you can watch for signs of those things in the order flow, right? And that's what makes it so accurate, because just watching the flow on its own, unless it like just like a really strong trend kind of pops up, which is like, you know, doesn't even happen every week. You know, just the flow on its own can be a little iffy sometimes, right? But if you have a kind of an informational edge on top of that, that kind of told you that it was going to happen before it even happens, that's where the real advantage comes from, right? Are they the ones that collect the data for the conference? Oh, okay. I did not know that. How do I don't need to go check. I mean, I think I've read all of the documentation there is about that survey, but we'll go back and do it again. We still got 10 minutes before that hits. Is that funny? It's only been 5 minutes. Yeah, you know what? I think one of the things that has kind of led to me being a little bit quieter lately and feeling frustrated is because we haven't been given a whole lot of opportunities to have that kind of informational edge. Like during the whole banking crisis sort of a thing, it's like by the time the news gets to me, it's like not useful anymore. It's you know, like the moves have been happening and we're searching and trying to figure out what's going on. We've been left in the dark a lot. So I guess that's just a function of this kind of market environment. I would have thought that this kind of market environment would be favorable to me, but it hasn't. Disney begins the first round of 7,000 expected job cuts. That sucks. I'm just kind of noticing, by the way. Remember when early in the stream, I had 2 contracts on, and I said, okay, well, here is one of the key market maker positions, and I'm already seeing kind of this behavior going on there, so I'm going to take it off. And that was exactly where it turned. And now we've come down just below the seller cost basis. Welcome to the normal market as things. Well, I wouldn't say that. No, it's the banking news in particular, right? Like, banking news seems to get to us late. It's like some bank is having problems, and so they're going out and trying to get funding and everything, and then other market participants notice that and start trading off of it. And then we don't actually get a headline that we can trade off of until like a deal has already been made, frankly. Right? Or we'll see the stock going down, but we don't know why. That's what due diligence means. It's just the market's all about informational inefficiency, right? There are certain kinds of informational inefficiencies that we as retail traders can take advantage of, and there are others that we're not very good at taking advantage of. And what I'm trying to say is that informational inefficiencies within the banking system itself, between the banks, we don't have a very good view into that. Twitter is going to fashion the For You feed differently for verified accounts? Almost every bank analyst on Twitter were calling SVB and Signature insolvent at least as far back as October. Okay. They may be true. But I'm still talking about, like, you come in and that day SVB Bank is down big. And why is it down big, right? Like, there's like a company is having problems, and then there's something's coming to a head. And how do you know that something's coming to a head? And these guys, they know some things that tells them that we don't have, right? $6E flying? I don't know. The dollar has kind of been a little wonky this morning, hasn't it? Bloomberg has a story about watches. I see a lot of stuff about watches these days, but maybe that's just because I never noticed it before. I don't know. Okay, so IMM dates are when swap future contracts at the CME expire. So you're saying that the reason it was coming to a head was because of swaps expiring? So let's take this from a different perspective here for a second. There was a lot of volatility the past, 2 or 3 weeks? Here this week, it's like the volatility has completely come out of the market. And I have all of these people saying, oh, there's no way that it's over. Like, another shoe is going to drop any day here now. Don't get comfortable, blah, 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 blah. The market overall is extremely, like, risk adverse right now, extremely pessimistic, right? But the actual action this week has been pretty lackadaisical, right? It's been pretty quiet. So is there another one out there? Because actually, the way that you're saying it says to me that you could know that there's another one lurking out there. And people just aren't paying attention, I guess. Right? So is there another one out there waiting to explode in the next month, let's say, that we should be aware of? Okay, that's what it sounded like to me. You said it like you do realize, and then it was like, oh, okay, so you're saying that we could have known. But no, I don't realize that all of these swaps are traded over on the CME, and that there's a date that they expire and so forth. Or that it was around that time or whatever. Okay, if it is lurking, the next time period it will blow up is around those dates. So when would that be? Next quarter? So you're saying that we got like 3 months? 3 months to enjoy things before somebody else blows up? I saw a move there that kind of caught my eye for some reason, but it still looks like it's just sitting there. Let's reset things, I guess. We'll give a gentleman's pass and say 6 months. Okay, sure. Not until like the September, October time of year, yeah. But maybe. I mean, I've kind of been thinking, that like, if you look at this, okay, so like we're seeing the banks blow up and everything, and everybody's like, oh, this is 2008 all over again. Their heads are all on fire, all of this sort of stuff. But when I look at it, this seems a lot more to me like the summer of 2008 before the crisis. Right? Like there was this slow breakdown that most people didn't see. And it wasn't until it was like, oh, the whole banking system is going to get pulled under that people actually saw it. And it kind of seems to be playing out in a similar fashion to me. Which if that's actually true, and that's highly speculative and just kind of a guesstimate, okay, it's nothing empirical about that. But if that really were the case, then we should see it falling apart in October. But I do think that I am very skeptical that the volatility is just going to completely come out of the market, right? Okay, here comes the news. Let's see here. March Richmond Fed Services Index -17 versus -3 prior. Still waiting for the consumer confidence number though. Liquidity is a little light here. They're moving around a little bit. Oh. I'm going to puke this over here on my sim trade. Was 104.2 versus an expected 101. So consumer confidence in the past month actually increased. That's not helpful for those that are concerned about inflation. After we got the news though, so far not too much volume. So I don't know, man. It sure seems to me like all of the data over the past month has kind of been, while we've been ignoring it because we had a crisis and everything, all of the data is saying inflation is still a problem and that we're in an inflationary environment. So I saw, who was it? It was Bill Ackman. So I was really surprised to hear Bill Ackman say this. Just because if a guy as big as him is out there saying it, how is the market pricing what it is? But he said that we are in an environment that is more inflationary, and that for the next few years, because of, deglobalization and so forth in particular, that we're likely to have inflation in the range of 2 to 3%. So how can you have future inflation be 2 to 3% and have the 10-year treasury notes only be like 3 to 4%? That doesn't make sense. The pricing of the bonds doesn't seem to reflect that. So of course, I guess what he's saying is a little bit speculative, right? But what was surprising to me is if a prominent investor as big as him is saying that, you would think that viewpoint would be more popular in the marketplace. And maybe it is popular in the marketplace, but it's just not actually showing up in price. And maybe there's some other factors going on that are making the price what it is, but right, kind of doesn't, it doesn't give you very much confidence in buying bonds, does it? And here we have yet another data point today that kind of suggests that inflation was a problem. If we didn't get like this banking crisis, because who knows, maybe this banking crisis was really deflationary, right? No. I think that he was saying that if inflation is going to be 3% per year, that you can't really have the 10-year be at 3%. And I think by proxy, you would have to say it would have to be more than 4%, right? Like if the 10-year treasury, well, maybe let's just go to fives. Let's just go to fives just for the sake of argument, okay? If inflation is going to be 3% for the next 5 years, does it make sense to get 3.4% on your 5-year treasuries? Right? Like you're only making 0.5% real interest rate. You say yes? Okay. Okay. But he the way that he was saying, he was implying that treasury yields should be much higher than they are. I mean, if they're going to be 3% for the next 5 years, I think that would kind of make the market be concerned about them going to 5%, right? And then you have a problem. But I also wonder where, does he have some way of calculating this, that based on these particular dynamics, that's actually what the inflation is likely to be? Like, how do you come to that conclusion? That's what I want to know. I guess at the same time, we have to be a little bit skeptical because Bill Ackman has made some pretty dumb calls in the past, right? You don't believe that at all? He made his wealth during zero interest rate prices. Not for a second I believe he advocates for higher rates. I didn't read it as advocating for higher rates. I think that he was saying that he was positioning himself for higher rates. That the longer term play that he was making was that inflation will continue to be an issue. Was on it. There was like an interview, and I would keep seeing parts of it on TikTok. Is where it comes from. So I'm sure you could probably go and find it. So it looked like some sort of a social media push by him, similar to what Ray Dalio was doing. . Okay, we did move now to the lower end of this range since the news, but I don't know. Well, there is some volume selling. There's about 5K sold. I don't know if we should really expect anything crazy after 22, because while that is the regular session high, there was prices just before the regular session that were lower than that. So these, our benchmarks for oh wow, this is turning into a really crazy downturn would have to be way further down, right? And I don't know if we're necessarily expecting a really crazy downturn either, so. Okay, so the book is being really light here. That looks to me more like a lack of interest rather than strain on the part of market makers, which is curious to me. I'm not quite sure what to do with that. Eurobond week high. Anthony Crudelli, there are a few times where I see no edges day in, day out in my strategy, and lately that's the case. This is a weak-handed market. The weak hands are puking into highs and puking into lows, and then the market reverts back. It's about sizing down and only taking your A set ups right now. That is, I mean, I find these sorts of things interesting because what Anthony just describes there, that definitely rings true to me about what this market seems like, is that it's not actually taking a really strong move one way. It's just people puking, right? But we can't prove that, right? I don't know how I would prove that that's the case, but it sure seems to ring true. Okay, SPOOs are rallying here, getting away from the kind of cluster of action that we've had since the open in the first 30 minutes. You could call it a breakout, but you never know, right? It could just revert right back into the noise, right? Okay. The 30-year looking a little bit heavier. I'm not detecting a change in the spreads. So I guess we just kind of have to go from here. So what about this congressional testimony? Let's see if I can get more information about that. Okay. So the federal officials testify in Silicon Valley Bank collapse is live at the moment. And I will give you guys the link. I'm not going to stream it over here. I'm going to rely on the news squawk. But you can watch it on C-SPAN over there. Let me come back over to Zero Hedge here. Having disappointed for the last 2 months, analysts expected the Conference Board's Consumer Confidence Index to extend its recent modest decline from 102.9 to 101.0, but instead it bounced a smidge to 104.2. The present situation weakened a little from 152.8 to 151, while expectations rebounded from 69 to 73. The Conference Board's gauge of one-year inflation expectations rose after tumbling in February. The Conference Board sentiment remains notably decoupled from the University of Michigan's sentiment measure. Finally, the Conference Board's measure of labor market tightness worsened, less jobs, plentiful versus hard to get. And that is not what Mr. Powell wants to see, is Zero Hedge's comment. Oh no, Adidas set to dump Beyonce. How could Beyonce not be making them tons and tons of money? You know, I saw this thing the other day that showed that like it was like a massive loss. It was like a multi-million-dollar loss for Nike to drop Kanye West. I was like, really? Because I kind of felt like it happened and then everybody just forgot about it and it was no big deal. But apparently there are costs to that sort of thing that I don't realize. So I'm getting that kind of that fishy ticking around where it's like market maker in charge. Yeah. Thinking about the time of day now. S&P 500 is still on an uptrend, but it's slow. And in order for technical traders to really call it like a true breakout, I think that they would get over this price that we set before the open at, let's say they would want to breach 40.10. Well, there's the treasuries right back down to the lows. Let's see if they go for it this time. Do you say at 416 there's strong resistance? Sure. So when we're thinking about like the price levels that we know matter in the S&P 500, there is some things that we have to say. I wouldn't say 4016 in particular, but really any price above 4,000, you know, a lot of analysts have been saying to sell there. Any bounce above 4,000 to sell. But I mean, the whole thing is that we had a banking crisis and the futures handled it really well. You know, like remember we were at 4,100, was it 4,200 maybe? And we were like, well, this is crazy that we're this high and we're likely to, you know, a lot of people were betting on the market just coming back anyways. So the market does come back, but then there's a crisis. So you'd think, well, there's a crisis, it would go even lower. Of course, we know that markets aren't informationally efficient, but if we were going on that they were informationally efficient, that's what we would expect, right? Is that they should go even lower. But then that's not really what happened, was it? It was, we're still at 4,000. How can that be? Right? It is a little weird to think about. But the equities were, given how much volatility there was in the market, it's just mind-boggling to me that we're still above 4,000 essentially. Live Squawk is tweets, a single bet on Deutsche Bank's C credit default swaps is seen behind Friday's rout, reports Bloomberg. Let's read that. Because I was frustrated by Thursday and Friday. Regulators are singling out a trade on Deutsche Bank's AG credit default swaps that they suspect fueled a global sell-off on Friday. It was roughly $5 million bet on swaps tied to the German bank's junior debt, according to people familiar with the matter who said regulators have spoken to market participants about the transaction. The contracts can be illiquid, so a single bet can trigger big moves, a spokesperson for Deutsche Bank declined to comment. The suspected knock-on effect was a rout that sent banking stocks tumbling, government bonds higher, and CDS prices for lenders soaring, trimming about $1.6 billion off of Deutsche Bank's market cap and more than $30 billion off of an index that tracks European banking stocks. That's because investors have been on edge since the collapse of several U.S. banks and the rescue of Credit Suisse, with the market searching for clues on whether other lenders would also face strain. European banks and their regulators have sought to underline that they have a close watch on risks, including rising rates, and that the industry is on a sound footing. Blah, 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 blah. It's unclear who placed the relevant trades or why they did it. Some data point to the trades being for hedging purposes, said one of the people. There's also a trade on Deutsche Bank's 5-year senior CDS contracts executed on Thursday that attracted scrutiny. One of the people said the search for triggers underscores a general lack of transparency in the asset class, which Andrea Enria, the European Central Bank's top oversight official, flagged on Tuesday. He also called for global financial regulators to take a closer look at the CDS market. I'm sorry, I'm trying to figure out Andrea. That must not be how you say it because it's a guy's name. Anyways, one of you Europeans will correct me. There are markets like the single name CDS market which are very opaque, very shallow, very illiquid. Enria said at a conference hosted by German newspaper Handelsblatt. Handelsblatt. With a few millions, you can move CDS spreads of a major bank and contaminate also stock prices and possibly also deposit outflows, he said, without naming any banks. Okay, so the implication there is that somebody was taking a big short in the CDS spreads of Deutsche Bank as part of a reflexivity trade. And can you make that? Is there something illegal about that? I don't think that there is, but regulators are looking at it. That is very curious to me. But that also kind of says to me, like they tried it and it didn't really work, did it? Or at least the markets, maybe they made money on the trade, but the markets have continued to be resilient. Ooh, where and when to see a rare conjunction of Venus and Uranus after sunset this week. That could be interesting. Nassim Nicholas Taleb replying to Elon Musk here, saying, yep, okay, wait, this could be interesting. Is Nassim actually agreeing with Mr. Musk now? Well, what was it that Musk said? I can't see the tweet. Let me see if I can find it. So Elon Musk posted this meme that says, babe, please stop. You're not even close to being a niche internet micro celebrity. And the Pepe says, yep, this one's doing numbers. This is totally me. I mean, my wife doesn't do that, but I'm totally always like, yep, this one goes off. I'm like, yep, finally got one to go. I'm so good at this, blah, blah. Well, not so good at this. I'm always frustrated, actually, to be honest. I'm often frustrated. Like, I don't think I'm as good at this as I should be for how much effort I've put in. Okay, starting April 15th, only verified accounts will be eligible to be in For You recommendations. This is the only realistic way to address advanced AI bot swarms taking over. It is otherwise a hopeless losing venture. Voting in polls will require verification for the same reason. Man, okay, and Nassim says, yes, Elon Musk charging for Twitter should bring cash flow and eliminate noise. It also brings independence from advertisers, but other social media outlets will need to do the same. In the post-zero interest rate area, noise reduction is essential. Okay, but here's the thing. I could come in and I could say, because I do tweet and maybe it's helpful to my business, or it could really help my Twitter account, because if I was more popular on Twitter, I think that would go a long way. I could justify paying for a subscription for Twitter. Yes, but I'm not going to pay to have a subscription to Twitter and Facebook and Reddit and TikTok and all, you know? Can't do it. I can maybe have one. I refuse to let this become like the TV thing. The TV thing, it was like, well, of course you have to have Netflix, but then there's Disney Plus because the kids like to watch Cars, so we have to have Disney Plus. And then I guess those are the only two that I pay for. But I also get HBO Max from my cable provider. And then you can pay for Hulu, which we've done at points, but I don't think we pay for that right now. There's just too many streaming services, and I don't want social media to become the same, okay? Please don't do that. Or if you do have a subscription, it should be like a really dirt cheap one, like $1, right? I don't know. What do you think? How much money a month are you willing to spend on social media subscriptions? $10? $50? I guess a lot of people would be willing to spend $50. Seems to me like $50 to $100 is kind of like that cutoff point for a lot of hobbies. It's like, if I'm spending more than that in a month, then it's, you know, I can't do that hobby. TLA Traders as 0. I don't know. You know, I kind of feel like because I agree with what they're saying here. I think that you make people pay for a subscription, that substantially increases the, you know, you got to get rid of the bots. You got to get rid of the bots. And that's always been a big problem on Twitter. I think I kind of want to get in on the Twitter subscription service just for that. Okay, well, it's still going here. Are we to our benchmarks? What are our benchmarks again? Overnight lows is 18. Oh, we are coming down to 18 with so much velocity though. And what is the deltas looking like too? Yeah, the deltas are, well, about 10K down since we've been in this. Let's see what happens. They were only briefly at 18 and somebody almost immediately hit it. So that 19 has got to be retail traders with the stops at 18 that, you know, as soon as it even was touched, they got stopped out. That's why you need to have the volume stop, guys, right? So that you don't get stopped out on that immediately. And then when it does go through 18, the stop will go and you'll get like 17 or something like that instead. You see some big MBO bids. Yeah. So I can't really see exactly, but I do see like the big ones that are sitting there. I don't know how long those have been there for. I'm not liking how it reacted to that touch. So I'm looking at my 10-year yields, and the 10-year yields have not moved too much since that touch of the lows, or rather they didn't pull back as much as the 10-year because the 30-year is being heavy. So a little bit of steepening here. But I also am seeing the spread come in here. So when I see the spread and the micros come in, that I'm always thinking about that, because that can provide a little bit better execution for us. Okay. So I'm not the only one thinking about it here. Somebody just sold 18. Okay. I didn't like how that happened. So I took 17 there. But I took 17 there. But like it almost immediately got filled, which makes me suspicious. Kind of says to me that I didn't actually get a good price at the very least. It's coming down a little bit. Feds Bullard apparently has put an essay out that we should read, saying that these problems can be contained. Looks like maybe I could have gotten the 20. Yeah, because 573 would have been 20. So part of me wants to try and hold it for like a break of the lows, right? But then I think about that and I'm like, no, I think this is the correct thing to do, because it's been relatively quiet. What makes me think that we're just gonna careen down through those lows? Hope. I always get too excited when I start to get to like those new prices, because that's, you know, that's how a trend starts, right? But I did not like the way that it bounced off of that the first time that it touched it. There was definitely somebody there buying it, waiting to buy when it touched that price. So I'm gonna say that was, I'm tepid on that I did the right thing. I do still see like the cumulative delta to the downside looks really good and everything. So like there could still be some possibility of going low, and I'll feel really awful about missing it. But you know, 17 for today isn't too bad. Is the book getting thick? Well, they are putting 1200s up. That's true. I think I'm a little bit on edge because, well, I don't know. So I was thinking that we would have a decline. I thought that it was going to be mostly from the news. Maybe it was from the news. But also, you know, we had a decline at 6:45 to 7. So then I thought around 7:45 to 8 we would get one. Okay, we did have one. So have we formed the liquidity hole here now at 20? There's a good chance that we did. I guess so. I was kind of wondering though, sometimes between 8:30 and 8:45 you get the move. But I'm realizing now, no, that move already happened. So I think that the exit was appropriate on the timing as well. I probably could have gotten a tick or two more. Yep, a little bit of a floater there. And that time the 30 years coming back big. So like I would have lost. See, now I'd be losing almost half of it. So wasn't too bad. I wish I hadn't have taken those trades last week. If I had waited through that whole thing and then taken today, I would be feeling pretty awesome. Because I think today was like, okay, it's more appropriate action for us, and we took a trade and it worked. So, and I didn't even have, did I even have any, well, it doesn't tell me, unfortunately. So I don't know how much MAE there was against me, but I don't think that there was any. Hey, NASDAQ, how are you doing? Haven't seen you. My mind's going back to I want to argue with Reddit. I saw some of these responses on one of my posts and I just kind of like turned off though. It's like, fine. Have fun with your price action. What's this, an ADHD thing? When doing a somewhat simple task, point at something you are about to do and say its status out loud to make sure you are doing it right or that you perceived it right, or maybe even to confirm yourself you did something. Look at the image in the post. I really recommend. Japan's famous rail network came up with a technique to prevent human errors called Shisha Kanko, or pointing and calling in English, which reduced human error by 85% according to a few studies. New York Subway adopted the same idea a few years ago and reduced errors by 57%. Basically, when you are about to do a task where a human error can occupy, you first point at an indicator, say the status, name, or condition of the indicator out loud. Another example is a conductor pointing at a green light, saying green light, and proceeding, or when checking their speed, they point at the speedometer and say the speed out loud. I have a hard enough time remembering the trades I took 30 minutes ago. Dude, I got that one good. Like, look, because our original entry was 3.553. They leaned hard on that overnight low. But that was just a determination. Okay, so here's the question. Do we have empirical evidence suggesting that overnight lows tend to act as support? Well, it seems like that would be something that would be really easy to test. I have tested things like that before, and I don't come out with profitable strategies out of it, although that doesn't necessarily mean, that could just mean it does act as support, but maybe you can't make money off of it. So how would you statistically express that a certain level acts as support, right? But I think more so with me here in this particular situation, it was a determination that we did have a piece of information that suggested that we should sell, but that it wasn't enough to overcome whatever might have been at the lows. Cycles. I have some empirical evidence that suggests that cycles are a thing in the market and that you can make money from them. But it requires like constant retraining to work. So, for what that's worth. But could you have expected that the overnight low would act as support? I don't know. Good question, Trading Bunny. I don't know. What is the logic behind support and resistance anyways? Is it that pending orders are placed there? If that's the case, why wouldn't you use a prior day or prior day high lows closes? Yeah, so why would you use this price level versus this price level? I've no clue. But yes, retail traders believe that certain areas act as support and resistance, which is to say that once you get to that particular point, you get more people willing to buy it. Now, here's the thing. Is that is not exactly how I read that order flow, right? So the way that I read that order flow was my benchmark is 18. So when I have a benchmark, I'm not trying to say that this price level is or is not likely to break. But what I am saying is that if this price level does break, that means that we're moving a little bit more than usual. We're a little bit more trendy than usual, right? If we're in a contracting liquidity environment, then what tends to happen is the moves just get smaller and smaller, and so you don't actually break out of previous areas, right? So it comes down to, do we have breakouts or do we mean revert at the last extremes, essentially, right? But when we got down there, it was pretty quiet, and it was pretty quiet the whole way. It did go a couple of prices lower, but this whole bit between 19 and 18, like look, only 19 traded at 18, 17, 17, 18 half, 2504 at 19. Okay, so a net 4,000 contracts traded down here. A net 4,000 contracts traded down here, as opposed to 23,000 contracts that traded at 20 and 19, right? So to me, that was we got to a significant break location, and like the market wasn't really very interested in playing it. So in that kind of a situation, why would they bust through? Unless there was a strong meta order. And we did have a meta order, but the meta order was kind of like a mild one. It was the consumer confidence number. The market didn't seem to be reacting to it too strong. Like that was what we had going for us. So in that situation, if I start to see evidence of a liquidity hole and it reversing and everything, it doesn't really make sense for me to hold it, does it? And that wasn't playing support and resistance, but it was making a bunch of kind of like discretionary decisions based on things that we know, right? But what was the thing that actually was the edge? Was the consumer confidence number is inflationary. So we made $17 because of that. And then we were able to use our reading of the order flow to manage the trade well, right? Mm-hmm. I wonder Hmm. So I also want to note that this push back up came on very little volume. So it was kind of like the market maker saw that there wasn't very much interest in there and just kind of let it come back up. Sorry, I was responding to about somebody left me another message recently. Man, it is hot in here today. I wonder if I need to adjust my heater. Oh, we got 15 minutes left. I am kind of wondering. It seems like they're slow. Like they got hard stopped here at like 23, where all of this volume was. So normally I would expect them to like fall back into where there was a previous hole, sort of a thing, but it's not. So that kind of does make me wonder if they don't take another look at those lows. What's this? Oh, somebody talking about currency movements and their effects on other markets, and leaving a really good comment, actually, on Discord. Cool. Well, there's 20.5. Or do they back up 563? Okay. I'm kind of thinking all this from the situation of like, well, what if I was still in this? How would I be feeling about this? I think I would be really hoping that they get back above 573. I think that my son yesterday must have was in here and opened up the heater vent or something, because the heater was on and was giving a lot of heat. I think it's kind of funny. Some people on Reddit are picking up like who I am, though. Okay, well. Oh, I didn't realize the S&P 500 had taken that big of a hit there. Was that? What time was that? Ah, that was when the treasuries came back up. They may have reacted to something that Fed's bar is saying in front of Congress. You know, I never responded to this comment by live action that the indices moving in unison of a macro catalyst gives more strength to a trade, but when they're not in unison, be very wary. I would say that's true. Like when you're having a strong meta order coming through, your instruments tend to move together. And when the market maker is in charge and nothing's really going on, there's like a lot more noise and they don't seem to be in line with each other, you know? So when I come in and I see the treasury, you know, if I'm looking for like a strong downtrend, I would very much prefer all of the treasuries to line up at the low of the day together and then go together and start seeing big volume come as they start breaking those lows, right? That's what I would like to see in like the start of a big trend. I need to get an i10 Gen 13. Why? I think that I need more video card power. That's what I need. So I'm noticing, I don't know if you guys notice it on the stream, but I do, because of the output to file and everything that I'm doing right now, I do drop frames and stuff. Maybe I should change my stream frame rate back to 30. I remember one of you guys really wanted it to be 60, and so we have it at 60, but we could switch it back to 30. And that would help with a number of things. It would make the smiles smaller, probably would put less strain on the encoders. The actual bit rate of the stream would look better. You just would be getting 30 frames instead of 60. So if you were to go back and slow things down, you wouldn't be able to see as much detail. Are you calling me an X Sax quant because I'm not an X Sax quant? Well, I was not a quant there. And I would like to run a fund that could outperform those, but I don't think I'm there yet. I guess the big move, the big plan for 2023 is start using the knowledge that we have to try and make that sort of a transition. Strong resistance will remain. Well, I think Barr must have said something that the market didn't like there, because the S&P 500 dropped 10 points awfully quickly, didn't they? Yeah, so I want to run like a live trading stream assistant that is using some sort of a neural network, like running a live language model sort of a thing. And we did one that was using the video card to transcribe what I was saying. And when I run that, it just totally jacks the stream up. So I would need to be running it on a really good video card on a second machine. Oh, geez. So Zero Hedge is saying, has this story about blame Friday's Deutsche Bank crash on a single CDS trade, and it says try not to laugh too hard. I think, I mean, there was a large trade that went through, right? I think there is some reflexivity going on in there, but it was, if he didn't do it, somebody would have done it. Yeah, relief rallies and remembering bear stearns. We were talking about this earlier. Sometimes I wonder if Zero Hedge is listening and they're like, yeah, Seth was talking about, let's put a story out about that. Because that was a good point, Seth. There's just those sorts of things. It's so funny. I'm sure that it's all just a coincidence, but it sure happens a lot. That, I guess that means that we're pretty good at knowing what's going on in the markets and saying stuff before people actually put stories out about it. Okay, so we're not quite to 573, but it does look like they're going to try and take another look at those lows. Yeah, or a video card or a graphics card, that's the same thing. So the reason it's important is that the video cards are very good at doing certain kind of floating point calculations, essentially. And that's what all of these neural networks are made up of. So it's a network of tensors, which are basically nerve cells that do a computation. So you if you have a video card, you can get better performance out of those models. You can run them faster, essentially. You can train them faster and you can run them faster. So if we were going to run a live trading assistant, we would need that processing power. And we would probably want it to be on a separate machine so that it doesn't disrupt the stream. Well, I think I better get going. There's not much to say. It's been a quiet market. I tell you what, this summer is going to be hard. If the summer turns into like your typical summer trading, and this kind of makes me worried about the summer. Okay. What do we say? Should you upgrade to a Windows 11? No. I would not. I'm gonna put today's title as Eerie Market Calm. I find the action of the markets here recently to be incredibly unusual. Just to go from like so incredibly volatile to so incredibly quiet is just really weird. So anyways, Windows 11, if you upgrade to Windows 11, it can certainly work. But I don't think that Windows 11 gives you a whole lot to really justify making the change, reinstalling everything, making sure all your software works with, and all of the other headaches that you have to deal with. And there's a couple of things that it does to the interface that you basically, in order to get your desktop to work like the way that mine does, with like, you know, have all the windows down here and you can click on them all and everything, you have to use like hacks and stuff. So, and not only that, but they haven't gotten, do not believe at least that they've gotten through to like a Windows 11 service pack. So usually you want to wait for that. So yeah, I wouldn't upgrade to Windows 11 yet. If not, wait for Windows 12, I guess. Okay, gotta go. I'll see you guys tomorrow.